In this video, we're breaking down the good, the new, and the bad tax provisions included in the One Big Beautiful Bill Act, or OBBB, through the lens of proactive tax planning. This sweeping legislation reshapes major portions of the tax code with significant implications for high net worth individuals, retirees, business owners, and families nationwide. I'm Clay Hostetter, the tax planning manager here at Rhame and Gorrell Wealth Management. I'm a CPA, PFS, certified financial planner, CIMA, and FRC. If you're wondering how these changes might affect your tax strategy or estate plan, we invite you to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. Without further ado, let's get started with the 5 good tax provisions under the new law. First, tax brackets locked in. The progressive tax brackets established under the 2017 Tax Cuts and Jobs Act from 10% to 37% are now permanent. Originally scheduled to expire at the end of 2025, these rates will no longer revert to the higher pre-2017 levels. This stability gives taxpayers more confidence when making long-term financial decisions like Roth conversions, realizing capital gains, or accelerating income into low tax years. Second, higher standard deductions. The OBBB codifies the higher standard deductions introduced by the TCJA, now set at $15,750 for single filers and $31,500 for those married filing jointly. These amounts will continue to be indexed for inflation. This shift means fewer taxpayers will find value in itemizing deductions, streamlining the tax filing process for millions and expanding access to efficient tax savings. Third, QBI deductions for business owners. The 20% qualified business income QBI deduction for pass-through entities like LLCs and S corporations is now a permanent part of the tax code. This provision allows eligible business owners to deduct up to 20% of their qualified income, reducing their tax rate significantly. New under the OBBB, a $400 minimum deduction per trade or business is now available for those with at least $1,000 of income and material participation, making this benefit more inclusive to part-time operators and sole entrepreneurs. Fourth, bonus depreciation. A major win for small businesses in the new tax code is the reinstatement of 100% bonus depreciation. This deduction allows small business owners to accelerate the depreciation expense deduction on certain qualified assets. This is a great tool to help lower taxable income in the first year of purchasing an asset. And finally, estate tax exemption increases. The estate and gift tax exemption rises to $15 million per person, or $30 million for married couples, permanently. This eliminates prior concerns about the exemption being cut in half after 2025 and gives high net worth families much more certainty in their multi-generational wealth transfer strategies. This exemption will also continue to adjust annually for inflation, preserving its real value over time. We've covered the major wins, provisions that are staying in place and providing continued value to taxpayers. Now, let's shift to new additions introduced by the OBBB. These changes represent entirely new opportunities or potential pitfalls that didn't exist under prior law. First, charitable deductions for non-itemizers. For the first time since the Temporary CARES Act provision, the OBBB makes it permanent for taxpayers to deduct charitable cash contributions without itemizing, starting in 2026. Taxpayers can deduct up to $1,000 if single or $2,000 if married filing joint, as long as the contributions meet a 0.5% AGI floor. This is a win for donors who regularly give but don't meet the threshold for itemizing. Second, the elder deduction. An additional deduction allowed for those over the age of 65 is the new elder deduction. This gives a $6,000 deduction for each taxpayer over the age of 65. This deduction starts to be reduced for single individuals with an AGI over $75,000 and $150,000 for those who are married filing joint. This benefit is meant to appease those who wanted Social Security benefits to be taxed less, and the deduction is actually set to expire in 2028. Third, the SALT deduction cap reverts. The state and local tax SALT deduction cap is temporarily increased to $40,000 in 2025, but this benefit is short-lived. The cap will increase by 1% annually through 2029 and return to the original $10,000 cap in 2030. In addition, the deduction begins to phase out for individuals earning over $500,000. Taxpayers in high-tax states should be especially mindful of this rollback. Fourth, tip and overtime deductions. New above-the-line deductions for reported tips and overtime compensation up to $25,000 each were introduced under the OBBB, but these are only available through 2028. They also phase out for individuals with modified adjusted gross income over $150,000 if single or $300,000 if married filing joint. Additionally, highly compensated employees are excluded entirely. These deductions are meaningful while they last, but they're not a long-term planning tool. Finally, car loan interest deduction. The OBBB introduces a new deduction for car loan interest up to $10,000 annually for loans on new American-assembled vehicles. However, this provision is also temporary, ending in 2028. The vehicle must be newly purchased and assembled in the U.S., and income phase-outs apply starting at $100,000 for single individuals and $200,000 for those married filing joint. Those considering a new vehicle purchase should take advantage of this deduction while it lasts. While some of these new provisions create fresh planning opportunities, not every change in the OBBB is beneficial. Let's take a look at the provisions that could limit deductions, reduce flexibility, or increase your overall tax burden. First, home equity loan interest. Under the OBBB, interest on home equity loans is only deductible if funds are used specifically for qualified home improvements. Using a home equity line of credit for purposes like debt consolidation, education, or investing will no longer yield any tax benefits, tightening the rules around an otherwise flexible financial tool. Second, clean energy credits. Some of the most popular energy-related incentives are sunsetting. The Clean Vehicle Credit, Residential Clean Energy Credit, and Energy-Efficient Home Improvement Credits are being phased out by the end of 2025. These incentives helped many homeowners and EV buyers reduce their tax bills, so those considering upgrades may want to act before the window closes. Third, miscellaneous itemized deductions. A wide range of previously allowable deductions like investment advisory fees, unreimbursed employee expenses, tax preparation fees, and union dues are now permanently eliminated. These were suspended under the TCJA, and the OBBB confirms they won't be returning. This is a particularly important change for employees who incur significant job-related expenses or who previously deducted investment management costs. Fourth, casualty loss limitations. The ability to deduct losses from fires, floods, and other disasters is now strictly limited to events declared as federal disasters. The OBBB did not expand the definition of qualified disaster areas, meaning losses from local and regional disasters, unless federally declared, will not be deductible. This significantly narrows the usefulness of this deduction for affected homeowners and communities. Finally, gambling loss deduction shrink. Previously, gambling losses were fully deductible up to the amount of gambling income. The OBBB trims that back to 90%, meaning gamblers can only deduct losses for 90% of their value. This results in a higher net taxable income for recreational gamblers, even if they break even for the year. Before we wrap up, there's a final surprise tucked into the bill that's raising eyebrows and generating buzz. Let's talk about something completely new and a little unexpected: Trump accounts. A new type of tax-advantaged account for children born between 2025 and 2028. These offer long-term growth, early withdrawals for education, business, or home purchase, and $1,000 in seed funding at birth. The One Big Beautiful Bill Act delivers a mix of permanence, opportunity, and limitation, making proactive tax planning more important than ever. From deductions and depreciation to wealth transfer and charitable giving, there's a lot to navigate and significant value in getting it right. If you'd like to explore how these provisions apply to your unique situation, we invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today. Thanks for watching. Be sure to like, subscribe, and follow for more updates on tax strategy, retirement planning, and comprehensive wealth management.